Anytime you have a CEO of a company say this,
I don't believe we have competitors.
or when you have an investor of a company say this,
It could be a big disruptor to Microsoft.
and when you have a conservative accountant say this,
But I have to admit, I was wrong about Palantir.
we better pay attention to this company. And of course, I'm talking about Palantir, one of the hottest stocks out there. Since the beginning of 2023, the stock is up almost 1,638%. But I think there's something everyone is missing and that investors should pay attention to. In this video, I'm going to talk about the good and the bad parts of Palantir. I'm going to talk about revenue growth, quality of revenues, profitability, free cash flow, and of course, the valuation. And then I'm going to tell you whether I own the stock or not. My name is Mariusz Konieczny, and I have been investing in the stock market full-time since 2009. From that time to the peak of 2021, I turned $10,000 into $7 million. I'm also the author of 11 books on investing and the founder of microcapexplosions.com. What does Palantir do? This is going to be quick since I'm sure you're all familiar. Palantir offers two main products, Gotham and Foundry. Gotham is for governmental clients and Foundry is for commercial clients. Through these products, Palantir can access clients' data in different formats, in different locations, and it serves it back to the clients in a form where clients can use this data to make actionable decisions to drive ROI or return on investment. In other words, clients can use Palantir's suggestions to increase revenues by, let's say, reaching out to this group of clients or potential clients and not reaching out to these ones. Or they can make their manufacturing process more efficient by relying on Palantir's suggestion. Think of Palantir's products kind of like an operating system. In a regular computer, you have all this hardware, like a monitor, keyboard, hard drive, and all this other hardware. Without an operating system, the hardware is pretty much useless. The same thing with data. Clients have all this data in different locations, in different formats, and Palantir takes this data and makes it useful and actionable. Without Palantir's software, this data can be as useless as the computer hardware without an operating system. Also, Palantir uses AI and machine learning to training its models. Because Palantir has the best access to all sorts of data, whether it's commercial client data or governmental client data, its models have the best environment for learning. Consequently, Palantir's models are way ahead of its competitors. Let's jump into the good parts of Palantir. Number one, revenue growth. Palantir has revenue growth. This graph looks exactly how investors love it. Stairs straight up to the ceiling. In terms of the percentage terms, this graph looks equally impressive. The reason why revenues are growing so fast is because Palantir is successfully solving clients' problems. The clients are getting their return on investment. Customers are making more money by using Palantir than they're paying to use Palantir. And believe it or not, this is rare. Number two, revenue quality. Not all revenues are created equal. Picture two types of revenues. One type is Netflix subscription revenue. The other type is revenue from selling a house by a real estate agent. Netflix revenue is recurring. It is a subscription-based revenue. It happens automatically, month after month after month. Commission revenue by a real estate agent is a one-type revenue. And Palantir sells its products on a subscription basis. So the revenue is recurring. And not only that, clients are very sticky because Palantir's products become so ingrained in the client's operations that clients become dependent on Palantir's products. Number three, big difference between $100 revenue that costs you $95 to make and $100 revenue that only costs you $20 to make. That's gross profit margin. And gross profit margin is another indicator of quality of revenues. Palantir has incredible gross profit margins of more than 80%. Number 4, profitability. You see, many growth stocks suffer from the lack of profitability. Not Palantir. Palantir has been profitable since 2023. And this is important because once a company becomes profitable, it can survive, it can thrive on its own without the need to go back to the market for additional financing. Next, capital light business model. The difference between capital intensive businesses and capital light businesses is night and day. For capital intensive businesses, think mining or shipping. These industries require massive amounts of capital. And most of these capital expenditures do not even show up on the income statement. So in other words, these companies can be profitable, they can show profits, but those profits do not benefit shareholders because they get eaten up by CapEx that only shows up on the cash flow statement and gets omitted from the income statement. Again, not Palantir. Palantir has a very capital light business model. This allows the company to have free cash flow because CapEx or capital expenditures are tiny in relation to net cash provided by operating activities. Next, balance sheet. Since Palantir is profitable in free cash flowing, it also has a very strong balance sheet. As you can see here, Palantir has over $5 billion of cash in the bank, and this $5 billion is allocated between cash and cash equivalents and marketable securities. Next fabulous thing about Palantir is its moat. Whenever a company makes a lot of money, there are others that want to get in on the action. That's why Warren Buffett coined the term a moat. Good businesses have a moat surrounding their business to protect them from the competitors.
I don't believe we have competitors. So I don't believe in the U.S. commercial market we have competition. I don't believe in the U.S. government market we have competition. I believe we are the only company in America, the only really relevant market that will allow you to do useful things with large language models.
Because Palantir has no competitors, or the competitors that are out there are so much weaker than Palantir, this makes it easier for Palantir to sign up clients. But after the clients sign up, they become very sticky, meaning there are high switching costs because Palantir gets ingrained into the client's operations and clients can't live without Palantir. Another great thing about Palantir is few number of clients. Did you know that Palantir only has 629 customers? Yes, the $2.8 billion of revenues in 2024 were generated only from 629 customers. And that's not a lot of customers, which means there's a lot of growth left for the future. No wonder that Alex Karp, in his February 2025 letter to shareholders, said that Palantir is at the earliest stages, the beginning of the first act of a revolution that will play out over years and decades. So these are the good parts about Palantir. And I completely understand why so many investors are so bullish on the stock of Palantir.
Palantir reported this week, and Alex Karp, who's the CEO, believes that Palantir will be the largest AI company in the world.
What about the bad parts? Finally, the section you have all been waiting for. What is so bad about Palantir? Is there anything bad about Palantir? Well, there is. And it's really 4 things: popularity, low profitability, dilution, and yes, you guessed it, valuation. So number 1, Palantir is way too popular. If you search on social media, YouTube, everybody and their mother seems to be making videos about Palantir. And so consequently, it's kind of hard to get a good deal on something that is so popular. You know, they say, when you hear birds sing, spring has already sprung. Number 2, even though Palantir is profitable, it's not very profitable, okay? For example, during the last quarter, Palantir reported 77 million of net income, but 55 million of it came from interest income. In other words, from the cash that the company has on the balance sheet. It has nothing to do with the business. Now, to be fair, if the management didn't pay themselves so much in stock-based compensation, then for sure this profitability would have been a lot higher. Number 3, dilution. Palantir shares count increases about 10% per year. And of course, stock-based compensation plays a big part in this dilution. Because Palantir's management, they pay themselves a lot in stock-based compensation. And this creates more shares, and the existing shareholders end up owning less of Palantir because of this extra dilution. With that being said, the biggest negative for Palantir is the valuation, which is number 4, the price. I mean, look at it. The current market cap is more than $200 billion. Remember, no matter how much you like something, at the end of the day, it is always price is what you pay, value is what you get. For $200 billion price tag, in this case, you are getting a company that is projecting to have $3.7 billion of revenues next year with adjusted free cash flow of $1.6 billion. That's 60 times revenues and 138 times free cash flow. That's way too steep for me.
No, God, please, no, no!
I prefer to invest in stocks where I get a little bit more value for my money. And therefore, I don't personally own any stock of Palantir. Actually, if you want to know which stock I own a lot of, like 1% of, I suggest you watch this video. With that being said, thank you for watching this video. Don't forget to subscribe, like the video, and most importantly, let me know in the comments below what you think about Palantir.